Hi everyone, and welcome to Investing Strategies. It's Alissa Coram with Investors Business Daily from the NASDAQ market site in Times Square. With the S&P 500 vying for a breakout to new highs, will it be able to hold its new high territory? Fairlead Strategies is here to provide a technical perspective on the market's action. Plus, we're analyzing the rotation into semiconductor stocks as an improving sector outlook is finally lifting the group back to a position of leadership. And gold is consolidating, but it's trading at its highest levels in over 6 years. State Street Global Advisors will tell us what's behind the commodity's big move in 2019 and what investors should expect from gold in 2020. Investing Strategies starts now. Okay, let's get started with this week's market insights. The S&P 500 is now hitting new all-time highs. Could the breakout indicate a shift away from the volatility that's defined much of the last several months? Well, joining me now to provide a technical look at the market is Katie Stockton, founder and managing partner at Fairlead Strategies. Thanks so much for being here today, Katie.
Of course, glad to be here.
Yeah, so we're now at new all-time highs for the S&P 500. It's taken us a little while to get here, and the last several months have been a bit of a bumpy ride. So what do you make of the fact that we are now back at all-time highs for the S&P?
As a technician, it is very exciting, as you can imagine, and we're seeing gaps up. So that's a good thing. It shows momentum behind the move. It shows that a lot of people were watching the final resistance for the S&P 500, which is right around 30.28. So the breakout is bullish from a technical perspective. It relieves the chart of that final resistance, and it reflects positive momentum, especially with the gaps up that we're seeing. For confirmation of the breakout, we like to see a couple of days, a couple of closing prices above that level to confirm, and then we can look at higher target prices. The target that we can derive from this breakout in particular is about 31.20, and that's based on a measured move, which really just assumes the trajectory of the current trend will maintain itself. As you mentioned, we'd seen a lot of volatility preceding this breakout or pending breakout, and that really was a trading range environment. So during that trading range, we never saw a lot of breakdowns, which was a good thing, but it was a very frustrating environment for many folks because it was very whippy on a short-term basis. Now, theoretically, with a breakout, we could get into more of a trending environment.
All right, so is it your anticipation then that we could see a little bit of sideways action from here? Ideally, seeing that confirmation and closes above this new high ground would be positive, but how quickly do you think that a new uptrend and holding above this new area could happen?
Well, it should happen immediately if this is a real breakout. We should see those consecutive daily closes above this week and get somewhat immediate follow through on back of that. We do have a short-term overbought condition that the market is contending with, so there's no guarantee that a breakout is confirmed. And if that's the case, I think it's just another little pause is needed to refresh the uptrend, and then we'll see a breakout anyway, because really around the world we're already seeing these types of breakouts, maybe not new all-time highs for different benchmarks, but certainly breakouts from that trading range that characterized global equity markets for a few months.
And then do you think that this also signals at least a little bit of a breather from the volatility that has defined the last several months, because we've seen quite the whipsaw action really tied to headlines a lot, but does this really signify that that's more or less in the rear view, at least for the time being?
It feels that way. There's no way to be certain of that, of course, but in a trending tape, you tend to see less of those downdrafts, less of that retracement, and of course that would be an easier market theoretically to trade because you can stay on the right side of the moving averages and really just sort of ride the trend. So theoretically, yes.
All right, and we shouldn't be expecting anytime soon a new test then of the longer term moving averages?
Well, the 200-day moving average has acted as support for the S&P 500 recently. It's, I believe, not too far below, around 2880, I believe. And you can never rule out a test or retest, but it's not a mean reverting factor. It's not something that acts as a rubber band for the S&P 500 where there's a pull back to that moving average or really any moving average, but rather we kind of keep an eye on those overbought conditions, look for sell signals, look for any kind of loss of market breadth or participation that would indicate a significant pullback. Of course, right now with breakouts underway, we don't have those.
Right. So with the breakouts being pretty widespread, what are you seeing in terms of the sectors that that now look appealing to investors?
Oftentimes what we see when you do see new highs and breakouts, you're seeing more offensive sector leadership, and by that I mean areas like technology, which tend to be more growthy, more cyclical areas of the market. And we are starting to see signs of life in some of those areas. I would also highlight financials as being a source of newfound outperformance. It's very new, as I mentioned, but it could be a basing phase in relative terms for financials, which could then be a new upside leader for the market.
That's right. And speaking of financials, let's turn our attention to this week's stocks to watch, starting with Bank of America. So the breakout theme continues here. Bank of America moving higher and looking like it's extending its gains. What are you seeing in this chart?
With the underperformance that we had seen from financials and Bank of America as one great example of that, especially in 2018, it felt like they were never going to get going again. And of course, now just in the last couple of weeks, we started to see some signs of life there where we're getting some breakouts above important levels. Bank of America cleared some former resistance, so previous highs where it had met selling pressure, and confirmed that breakout. It's a little overextended short term, I would say, but that breakout completes a trading range that had been in place for several months. So again, there it releases the chart of resistance. It supports upside follow through beyond the near term and shows a resumption of the uptrend that preceded that underperformance in 2018.
Right, and this type of action in the group isn't isolated, of course. Others like JP Morgan also with similar chart action. So this group does look like it has more than just one chart that is a bright spot.
That's fair to say. Even the regional banks are acting much better and making higher lows and then subsequently exceeding these short-term resistance levels. All of that would make them a turnaround play, and I do think it's best to have core long positions in long-term uptrends, and that would not qualify for many of the financials. And yet now with this newfound leadership, I do think people should be, sniffing around for good opportunities.
Fantastic. And then another area on your radar is the emerging market. So let's take a look at the EEM iShares Emerging Markets ETF. What are you seeing here? Because at first glance, it doesn't really look like it's done a whole lot lately, but could that change?
Well, it's finally captured some short-term momentum, and in doing so, it's actually climbed above a year-long downtrend line that if you take a step back on the chart, it looks like a big triangle formation that's now being resolved to the upside, which is the direction of the prevailing trend before it was established. So lower highs, higher lows, there's the triangle. You see the breakout above the downtrend line, and it's a fairly high probability setup where you tend to see upside follow through, and this would be months in nature, not just weeks in nature in terms of the implications. So I think it bodes well for emerging markets, not necessarily to be a source of great leadership globally, although there are some signs of life as the dollar has pulled back there, but rather to finally participate in what I think is a global rally.
Right, and maybe look at this area as being able to not have that home bias and being able to diversify in other areas that could be strengthening.
Well, it's a testament to the global breadth behind the move. So we do want to see broad participation, not just here in the U.S., but also globally, and that really enhances the sustainability of the uptrend. We're already seeing breakouts in overseas markets like the German DAX as one great example of that, and these aren't necessarily new all-time highs, but we are seeing those breakouts, and I think we'll start to see even some spreading out of the rally to things like small caps, other areas that had underperformed.
So it seems like the message then at the end of the day, at least for the time being, is a lot brighter of a picture than all of the uncertainty and volatility that had been really dominating the markets.
I think it's a relief of that trading range to the upside, and of course that does make it a more clear picture ahead from a technical perspective if indeed these breakouts are confirmed, which it looks like even if it doesn't happen this week, it probably will happen. And we do have some positive seasonal influences underway potentially in Q4. So it bodes well for that as well.
All right, well, I think this is the perfect time to really dive into the technical side of the market. So thank you so much for sharing with us what you're seeing in the market right now.
Of course, happy to.
All right, and after the break, we're going to continue our discussion about sector rotation with a look at a group that's finally leading the market after a period of underperformance, and that's coming up next.
Pick winning stocks with MarketSmith. Growth 250 shows you ideas with big potential. View charts packed with key data. Use pattern recognition to see action zones. MarketSmith by Investors Business Daily. Try 3 weeks for $19.95.
Now, it's important for investors to keep tabs on sector rotation because if you know which sectors are leading the market, that'll improve your ability to select top stocks and enable you to invest in sectors that are outperforming the market. And after a nearly 2-year period of underperforming the market, we're now seeing strength in semiconductor stocks amid expectations for a turnaround in the chip industry cycle. And this strength can be evidenced by the action in the VanEck Vectors Semiconductor ETF SMH. After a long consolidation in 2018 and choppy action in 2019, SMH is trading solidly at all-time highs. It also remains in buy range from a breakout past a 123.23 entry of this cup with handle base here. Now, SMH tracks the MVIS US listed semiconductor index, which holds the most liquid chip stocks based on market cap and trading volume. This strength in chip stocks is a positive development for the overall stock market because the semiconductor market is a key sector of the global economy. Chips play a vital role in many industries, enabling emerging trends from 5G to cloud computing to self-driving cars to AI and the Internet of Things, among others. And within the semiconductor sector, chip equipment makers like Lam Research have been leading the group. LRCX broke out of a base in early September, and after a small run, the stock was able to hold its gains and move sideways for several weeks. Then the stock blasted higher on October 24th in reaction to its quarterly earnings report. The report showed narrowing declines on the top and bottom lines, and the company's outlook was strong. The move put shares more than 20% past its buy point from early September and was accompanied by heavy volume, which indicates strong demand from institutional money managers. Now, group peers KLA, MKS Instruments, and ASML have also been strong performers as of late. And another example of recent strength in the semiconductor sector can be found in Taiwan Semiconductor, which broke out of a cup with handle base several weeks before its latest quarterly report. Now, the stock wobbled a little bit after the report was issued, but shares are now trading at all-time highs, up some 14% from the 44.98 buy point here. And elsewhere in the group, NVIDIA is hitting 11-month highs heading into its quarterly report next month, and Intel surged higher on October 25th after its latest quarterly earnings report, breaking out over a prior resistance level. Now, while breakouts and run-ups across the group are positive, they're not universal. Texas Instruments gapped down on its latest quarterly report, so keep an eye for continued signs of a recovering chip industry cycle and be aware of potential threats to the group from the ongoing U.S. and China trade war and fears for a recession on the horizon. All right, well, coming up next, we're sitting down with State Street Global Advisors to put this year's gold rally into perspective and analyze the outlook for gold in 2020. We'll be right back.
This season on Cultural Capital, we are in New York City and San Francisco. Come with me as I tour some of the world's most innovative companies, from Squarespace to C3AI, Giphy, and Figma. Learn how CEOs built growing companies while maintaining the ultimate office culture on Season 3 of Cultural Capital on the brand new NASDAQ.com.
While gold has been consolidating over the last 2 months, it's been on the move in 2019. The Spider Gold Shares ETF GLD is holding at its highest level since the spring of 2013. And here to share insights about the precious metals gains this year and where gold could be headed in 2020 is George Milling-Stanley, Chief Gold Strategist at State Street Global Advisors. Thanks so much for joining me today, George.
Thanks for inviting me.
So, as I said, gold's been on the move this year, but taking a step back and looking at the bigger term picture, what does the move move really mean in terms of what we've been seeing over the long term for gold?
No, I think it's a pretty substantial move. I mean, it's an inflection point, if you like. Gold was holding in a very, very narrow range for the 6 years from the spring of 2013 right up until June of this year. And every time the price popped its head above the $1,350 area, speculative interest would play whack-a-mole and knock it back down. They didn't do that in June when the price started to move up. And it's important to try to understand why. I think the suggestion from Jerome Powell that the Fed was going to make a mid-cycle adjustment, I believe it was called at the time, and lower interest rates at the July meeting was probably the proximate cause for why gold has gone up a good deal since then. We're now kind of filling in a bit of the gaps that we left behind, having moved $200 above that trading range that have been there for 6 years. And I think that's actually very healthy. So I'm kind of pleased with what gold's been doing recently.
All right, and gold is, of course, known as a very popular safe haven asset. And we have seen a lot of volatility coming into the market over the last few months. That may be subsiding a little bit now, but do you think that that kind of relationship between gold and volatility still exists to some extent or not?
Oh, no question. I mean, volatility in other markets has been one of the keys. There have been a lot of different things behind gold's move up. First, there was the interest rate move, and then a subsequent move in September, and markets are expecting this week yet another cut. And then negative interest rates on fixed income securities all around the world. That's another driver towards gold as a safe haven. Volatility in the equity markets. You know, the best news in markets is that equities have gone up for 10 straight years, but nobody in their right mind expects that to be repeated over the next 10. So people are very, very concerned, and that level of concern drives people toward safe haven assets like gold.
Right, and speaking of investors flocking to gold, can you tell us a little bit more about the demand that's behind this move that we've seen?
Yeah, I mean, obviously, investors' safe haven buying is one of the keys. We've seen continued good physical demand in the emerging markets. In both jewelry has held up remarkably well. Investment demand in the emerging world is growing, whether it's into bars and coins or into ETFs increasingly. So we've seen a lot of that kind of demand coming as well. Institutions and individuals gradually putting together small strategic allocations to gold because of its defensive properties, because of its diversification properties. All of this coming together has been is very good reasons why gold is $150, $200 above that trading range.
Right, and then in terms of the GLD ETF, what are we seeing there in terms of the inflows?
We've seen inflows of $6.5 billion this year into GLD alone, taking it to the $45 billion level in assets under management. That's pretty good going for something that will turn 15 years old in a couple of weeks. We'll be ringing the closing bell on the NYSE in a couple of weeks' time. And then there's our junior product, GLDM, the mini version. That's only been around for about 14 months, but has already amassed more than $1 billion in assets, including taking in $500 million this year alone. So the fact that GLDM, the mini product, and GLD, the big kahuna, have been growing together, to my mind, is definitely reflecting investor interest in ETFs.
Right, and there was a long period of time where the multi-year gains were really sustained for gold, but as you mentioned, there was that 6-year period of moving kind of sideways. So what do you tell investors who aren't sure about the long-term performance that they're going to get with gold?
I think the best example of a long-term trend in the gold market was from 2001 to 2010, when increasing levels of economic activity throughout the emerging world led to gradually increasing purchases of jewelry, and the gold price went up from $250 an ounce to $1,250. This current period seems to me like we're embarking on something very, very similar. A lot of the background is very similar. Nervousness in equity markets, nervousness in fixed income markets. Investors just basically concerned macroeconomically, geopolitically. There are worrying things everywhere you turn. And I think we're moving into something very similar. I can see gold looking to try to establish a new higher trading range than the one that we saw over the past 6 years. Whether we're staying around the $1,500 level at the moment. I think that what gold is doing is shoring up the foundations for a move higher. And it's important to remember also that we're just moving into what is typically the strongest 6 months of the year for physical demand across the emerging world, with the Diwali festival in India leading to the marriage season. We're looking for good demand across the world for the next 6 months. I think that points to higher prices.
All right, so in the next 6 months, that brings us into 2020, which and it's an election year, not to focus too much on that, but could that bring further volatility or uncertainty to the market, or is more of the focus on the holiday shopping season and that bringing strength?
I think
gold?
it depends on where you look in the world.
Right.
The wedding season shopping for jewelry in India for the next 6 months will be very important. Chinese New Year, when it comes, will also be very important. Our election season is only going to add to the general uncertainties against which gold is operating, and that just means that the background, the environment in which gold is performing, becomes ever more favorable.
Right, and so then in terms of asset allocation in the portfolio, how should investors be utilizing gold within their portportfolios?
Well, we don't say anybody should put 100% of their money into gold. That to my mind doesn't make sense. There have been times when it would have been a good idea, but not enough. What we do say is that everybody should have a properly balanced portfolio with some fixed income, with some equities, maybe some commodities, some real estate, and every portfolio should have some gold in it. A lot of people are comfortable with a 5% level. Other people feel a little bit higher right now, given all the prevailing circumstances are being so favorable for gold. There are a lot of people I've been talking to recently who say that 10% is the correct level right now. Obviously, there's no one answer for every investor. Every investor's risk tolerances, liquidity needs, all of that is different across the board. So there isn't one pat answer. But somewhere between 5 and 10% right now would seem to make sense.
Right, and there are obviously a variety of ways that you can invest in gold. Why do you think that the ETF wrapper is a good option for investors?
Because it's so transparent, because it is so deeply liquid. GLD is turning over between $1.5 billion and $2 billion a day in terms of stock. Now that's only 1% of the total turnover in the gold market, but it is significant, and it has contributed to general strength in the gold business as well. I think the liquidity has been one of the principal ways, the transparency, the specific bars that back GLD. That bar list is updated every day on the internet, so people know exactly what it is they're buying. They're not buying gold, they're buying exposure to movements in the price of gold. They own a trust, and the trust owns the gold. It's a very, very simple equation, and investors have embraced it with great enthusiasm.
Great. Well, it sounds like gold might be poised for the next leg higher, so we'll have to see where it goes from here. Thank you so much for sharing all these deep insights with us today.
Thanks for the opportunity to talk to you.
Really appreciate it. All right, and thank you all for watching Investing Strategies this week. We'll see you right back here for our show next Monday, featuring the Chief Investment Officer at Vies and X Out Capital. Until then, I'm Alissa Coram.